Today, we're tackling a topic that a lot of you have asked about. Something that can feel super intimidating but is actually one of the most powerful things you can do for your future. Investing. If you've ever thought, investing is too complicated, or I don't have enough money to start, then this video is for you. We're going to break down how to start investing step by step, even if you have absolutely no experience. By the end of this video, you'll have a clear, actionable plan to get started. So let us get one thing straight right away. Investing isn't just for Wall Street sharks in fancy suits. It's for everyone. It's simply the process of making your money work for you. Instead of letting your cash sit in a savings account where it barely grows, investing gives it the potential to grow much faster over time, thanks to the magic of compound interest. Think of it like planting a tree. You start with a small seed, and over time, with a little care, it grows into something massive that provides shade and fruit for years to come. Your investments can do the same thing for your financial future. Now, before you even think about putting a single dollar into the market, we need to lay the groundwork. This is the most important step, and skipping it is like trying to build a house without a foundation. First, you need to get your financial house in order. This means tackling any high-interest debt like credit card debt. The interest you're repaying on that debt is likely much higher than any returns you can expect from the stock market in the short term. Paying that off is a guaranteed return on your money. So, make a plan to aggressively pay down those high-interest loans. Next, you need an emergency fund. Life is unpredictable. Your car might break down, you could have an unexpected medical bill, or you might lose your job. An emergency fund is your safety net. It's a pool of cash, typically 3 to 6 months' worth of your essential living expenses, kept in a high-yield savings account where you can access it quickly. This is crucial because if an emergency happens and all your money is invested, you might be forced to sell your investments at a bad time, potentially losing money. Having this cash buffer gives you peace of mind and protects your long-term investment strategy. All right, with the foundation laid, let's talk about goals. Why do you want to invest? Your answer to this question will determine your entire strategy. Are you investing for retirement in 30 years? Are you saving for a down payment on a house in 5 years? Or maybe you're building a fund for your child's education in 15 years. These different time horizons are key. For long-term goals like retirement, you can generally afford to take on more risk because you have more time to recover from any market downturns. For short-term goals, you'll want to be more conservative to protect your principal. So grab a notebook and write down your goals. Be specific about what you're saving for and when you'll need the money. Now for the exciting part. How do you actually start investing? You'll need to open an investment account, also known as a brokerage account. Think of a brokerage as a store where you can buy and sell investments like stocks and funds. There are many great options out there today, especially for beginners. Look for brokerages with low or no account minimums, zero commission fees for stock trades, and a user-friendly app or website. Some popular choices include Fidelity, Vanguard, and Charles Schwab, which are great full-service brokers. There are also app-based platforms like Robinhood or Webull, which are known for being very easy to use. Do a little research, compare their features, and pick the one that feels right for you. Opening an account is usually a straightforward online process that takes about 15 minutes. So you've opened your account. Now what do you actually invest in? This is where many beginners get paralyzed by choice. You hear about stocks, bonds, mutual funds, ETFs, it's a lot. Let's keep it simple. As a beginner, one of the best ways to get started is with low-cost index funds or exchange-traded funds, also known as ETFs. An index fund or ETF is like a basket that holds hundreds or even thousands of different stocks. For example, an S&P 500 index fund holds small pieces of the 500 largest companies in the US. By buying just one share of this fund, you are instantly diversified. You're not betting on a single company to succeed. You're betting on the overall growth of the US economy. This strategy dramatically reduces your risk compared to picking individual stocks. It's the strategy recommended by legendary investors like Warren Buffett for the vast majority of people. Let's dig a little deeper into why these funds are so great for beginners. First, instant diversification. If one company in the fund does poorly, it has a very small impact on your overall investment because it's just balanced out by the other 499 companies. Second, they are incredibly low cost. The fees, known as the expense ratio, are typically very, very low, often just a few dollars a year for every $10,000 you invest. High fees can eat away at your returns over time, so keeping costs low is essential. And third, it's a passive strategy. You don't have to spend hours researching individual companies or trying to time the market. You simply buy the fund and hold on for the long term, letting the market do the work for you. So how much money do you need to start? This is the best part. You can start with whatever you're comfortable with. Thanks to something called fractional shares, you don't even need enough money to buy a full share of an expensive ETF. You can invest as little as $1 or $5. The most important thing is not the amount you start with, but the habit you build. The key is to be consistent. Set up an automatic transfer from your bank account to your brokerage account every week or every month, right after you get paid. This strategy is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. This smooths out your purchase price over time and takes the emotion out of investing. You're not trying to guess the market's next move. You're just consistently building your wealth. Now let's talk about mindset. This is just as important as the mechanics. Investing is a long-term game. The stock market will go up and it will go down. There will be scary headlines and market crashes. It's part of the process. The worst thing you can do during a downturn is panic and sell. History has shown that the market has always recovered from every single crash and gone on to reach new highs. Your job as a long-term investor is to stay the course. Ignore the daily noise. Don't check your portfolio every 5 minutes. Trust in your strategy, keep investing consistently, and let time and compounding work their magic. Remember that chart of the S&P 500 over the last 50 years? It's a jagged line day to day, but the overall trend is powerfully up and to the right. That's what you're investing in. So let's recap the simple 5-step plan for any beginner to start investing. 1. Build your financial foundation by paying off high-interest debt and creating a 3 to 6 month emergency fund. 2. Define your financial goals and your time horizon. This will guide your entire strategy. 3. Open a low-cost brokerage account. Choose a platform that is beginner-friendly and has minimal fees. 4. Start investing in low-cost, diversified index funds or ETFs. Don't try to pick individual stocks. And 5. Automate your investments and stay consistent. Practice dollar cost averaging and commit to a long-term mindset. That's it. It really can be that simple. You don't need a finance degree or a 6-figure salary to start building wealth. You just need a plan, a little discipline, and the patience to let your investments grow over time. The best time to start investing was yesterday. The second best time is today. Taking that first step is the hardest part, but you're now equipped with the knowledge to do it confidently. Thank you so much for watching. I hope this guide has demystified the world of investing for you and made it feel much more accessible. If you found this video helpful, please give it a thumbs up. It really helps the channel out. And be sure to subscribe and hit that notification bell so you don't miss our future videos on personal finance and investing. If you have any questions, drop them in the comments below. I'll do my best to answer them. Thanks again for tuning in, and I'll see you in the next video.